Hello, I'm Marigold and we are from Group 7. Today's presentation looks at ESG in banking, focusing on the case of DBS Bank. We will explore what ESG means, its benefits and challenges, as well as regulations, greenwashing, and its impact on bank performance and stability. First of all, meet my two other teammates, Julie and Johan, who are also involved in this presentation. This slide here shows the agenda of our presentation today. Next, let's start by introducing ESG. ESG stands for Environmental, Social, and Governance, and it refers to non-financial factors used to assess a bank's sustainability and risk exposure. Rather than focusing only on one option, ESG considers long-term value and how business activities impact both current and future generations. In banking, ESG is especially important because banks play an important role in allocating capital and influencing economic activities. Environmental factors include climate risks, carbon emissions, and how resources are managed. While on the other hand, the social factors focus on how banks manage relationships with stakeholders, such as data privacy and human rights. Finally, governance relates to how banks are managed, including ethical practices and transparency. This is reflected in how banks like DBS incorporate ESG into their investment in sustainable finance solutions. Now let's look at ESG in banking through the case of DBS. ESG has become a strategic priority for banks, driven by increasing risk exposure, regulatory requirements, and stakeholder expectations. Banks face key ESG risks, including climate risks, regulatory pressure, and reputational risks. This diagram shows how ESG affects DBS through these three drivers. Importantly, DBS was recognized as the world's best bank for sustainable finance in 2025. It offers sustainable financing and ESG investment solutions to support the transition towards a low-carbon economy. This shows how ESG is integrated into DBS' core business strategy rather than treating as a separate initiative. Moving on to the benefits and challenges of ESG. In terms of benefits, ESG improves risk management by helping banks identify environmental and financial risks early. It also strengthens reputation and stakeholder trust, which is crucial in banking. In addition, ESG supports access to capital, as investors increasingly demand sustainable investment options, which is reflected in DBS ESG investment offerings. Overall, ESG contributes to long-term resilience and sustainable growth. However, ESG adoption also presents challenges. It involves high implementation and compliance cost, a lack of standardized ESG metrics, and potential trade-off with short-term profitability. Finally, greenwashing remains a concern, particularly if ESG commitments are not supported by real actions. Now I will pass on to my teammate Julie to explain more about ESG regulations.
Thank you, Marigold. Now let's talk about ESG regulations. ESG are the rules that guide sustainable banking. In Singapore, this is mainly regulated by the Monetary Authority of Singapore, also known as MAS, which introduced the Environmental Risk Management Guidelines in 2020. These require the banks to manage climate and environmental risk. Globally, banks like DBS Bank follow frameworks such as TCFD for climate disclosure, UN Principles for Sustainability Goals, and Basel Committee for Risk and Stability. Overall, the main goal of ESG is to improve the transparency, risk management, and financial stability. Now let's move on to the next slide. MAS requirements requires banks to integrate climate risk in lending and investment decisions, and also conduct stress testing for environmental risks. There is also increasing emphasis on climate disclosure aligned with TCFD. In addition, MAS introduced the Green Finance Action Plan to promote sustainable finance. In response, DBS has committed $50 billion Singapore dollars in sustainable financing, and is gradually phasing out coal-related financing to show how regulation directly influences bank behavior. Now let's move on to the next slide. Now we can talk about greenwashing, which refers to the misleading, exaggerated ESG claims about sustainability. In banking, this could mean labeling projects as green, even if their actual impact is limited. This is a concern because it misleads investors, leads to a misallocation of capital, reduces trust in ESG reporting, and slows real climate progress. In the case of DBS, it has no strong evidence of being greenwashed, and it is often recognized as a leader in sustainable banking. However, it has faced criticism for still having exposure to fossil fuel industries, and this reflects a broader debate whether banks should completely exclude such industries for support their transition. So, in response, DBS has adopted the transition approach and has committed to achieving net zero emissions by 2050. Now, I'll be passing on to my teammate Johan.
Thank you, Julie. Now, here and I'll be sharing on DBS's performance. In the return on assets chart, there is a slow and moderate increase over time. As well for the return on equity chart, there's a consistent improvement except for 2023 to 2024. Profitability has improved greatly since 2020. Although ESG does not automatically raise these two, we can see that over time there is a changes, right? ESG leading to stakeholder trust and stability and good management, right? Now onto the revenue analysis, right? See, for stability here, we have the 5-year summary of capital risk, loss buffers, asset risk, and liquidity risk, right? For the capital risk, we can see that the CET one increased over time, right, from 13% all the way to 17%. Now, in the NPL rate for risk asset risk, right, it fell over time, and loss allowance has increased by over 19% over the 5 years, right? Liquidity risk, loan and deposit ratio has slowly decreased, and these are stability indicators that show improvement over time. Now, the Z index combines profitability, capital buffer, and earnings volatility, right? These proxies point in the same directions, right? Showing stronger capital, stable earnings, and improved asset quality increase, right? Empirical research also finds that ESG performance can be associated with improved bank stability, right? And here we can see over time that the Z index is slowly increasing and is quite stable, right? Except for a hiccup in 2022, there's a slow and consistent increase over time. Now, for short-term, medium-term, and long-term impact, right? Here, we can see in the short term that ESG can decrease the performance slightly because of costs so far, right? But it does enhance control and management in the company. So once you get over that short term, you can start to see greater performances, right? And improve your own company's discipline and ability to conduct work. And by the time you reach the 5 years, you can see shareholders and investors being more loyal to this company and its ESG factors. Now, in conclusion, here we have that the ESG strategy for DBS is through governance and transition, and then scaled sustainable finance, right? It shows improved performance with stronger stability over time. And therefore we can conclude that ESG is most likely to be associated with building stability and resilience in the medium to long run, whereas in the short term, profitability may face implications. And overall, I feel it is a good idea for any long-term company to be establishing ESG within its management and goals. Thank you for your attention.